Hi everyone, can you hear me okay? We're going to go ahead and start this webinar right now. Welcome. We're going to have Price Headley demonstrate the Big Trends Toolkit. Price is actually first we need to read the disclosure, which is standard for those of you who have attended a webinar before. This demonstration is designed to instruct you on using MetaStock software and accompanying plugins. It is not a recommendation to buy or sell exchange-traded instruments, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented should only be used by investors who are aware of the risk inherent in trading. Thomson Reuters shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with this company. Okay. So now that we've got that out of the way, we can get to the fun stuff. Let me tell you a little bit about Price Headley, who is one of our partners. Price has been with MetaStock for a while now, and he is the brains behind one of our best-selling add-ons, the Big Trends Toolkit. Price has also attended many MetaStock conferences and presented at them, and he always gets great reviews when he presents. So without further ado, I'm going to have Price Headley take over.
Hey, thanks, Alex, and hello, everybody. Price Headley here. Glad to be with you. Let me make sure I'm coming in loud and clear. Type in what type of a trader you are. Are you more of a day trader, swing trader over 3 to 5 days, position trader 1 to 4 weeks, or maybe longer term than a month? Just kind of curious what types of crowd we have with us here today. So we've got a little mix of swing and position, day trader here or there, a little longer term here or there. Okay, that's good. Quite a few longer terms popping in there. That's helpful because it tells me a little bit about, what type of group we have. And the reality is that everything I'm going to share with you here today is really geared across any time frame you want. It's just about choosing what is the right time frame you should be trading, because the reality is if you're trading on a day-to-day basis intraday, you're going to need to use the right kind of intraday chart versus a longer term trader should not be overreacting to intraday charts. And that's something I see as a common mistake that a lot of traders are making. So we're going to show you how to really zero in on that the Big Trends way. And so let's go ahead and get started here. Now, when we look at, I'm actually going to go to full screen here, and then hopefully don't mess it up on us here. We can take it out of that mode here momentarily. But the bottom line is that this is the Big Trends Toolkit, what we call the BTTK in MetaStock. And there's a variety of indicators and systems. These are actual specific strategies that you can get specific buy and sell arrows on. And to me, that's really critical because it really gets you back into a mode of saying, where is the buy signal, and more importantly, not just how to get in. We don't want to be in a trade that's what I call a roach motel, that's easy to get in and hard to get out, but rather saying, hey, let's make sure when we get an exit signal, we exit first and ask questions later. And so you can see acceleration bands, the DMI difference, the efficiency ratio. These are things that I've developed over the years. I've been trading for about 22 years. And I've also got some things in here that you may have heard of from other trading gurus and experts like Alexander Elder with the Force Index. I tested that, and it actually tested pretty well as little modified settings there, using MACD in a different way, looking at relative strength for a market indicator. And one that's one of my favorites, the percent R indicator Larry Williams developed, but I really tweaked it quite dramatically to get more of a trend following component to this. Let's talk about a few of the concepts because, what I find a lot of traders are having a lot of trouble with is what I would call information overload. Do you ever feel like you're maxed out on too much information coming at you all at the same time? I think most of the people that I talk to are saying the same thing, that they're seeing that information overload kicking in. They're saying, okay, well, we've really got to have a way to manage that. And so the way that I manage that is by really going in and focusing on what I would call speed of movement. That is, let me find the faster trends, the trends that are really heating up on the upside or more recently on the downside. You see the market kind of groping for a bottom. We've got all the problems in Europe. But the market seems to want to be showing a little bit of resilience today. We were down 180 points on the Dow, came back to finish down only about 6 or 7 points. So, NASDAQ finished positive after being down more than 1%. So we want to know which are the stocks that we should be trading across this, what I would call the best stocks, which typically are not going to come back to give you that easy entry point. It's kind of like the Facebook IPO. When everybody was able to get all the shares they wanted at $42 on the opening price, that wasn't such a great sign. good traders know that it's hard to get on board good movers, that you have to be willing to pay up for good movers rather than trying to buy low and end up selling lower. So we're going to talk about some of these adaptive concepts that I've really zeroed in on here to help you find the best of the best trends. You know, when I looked at adaptive bands back in the 90s, the one that everybody talked about was John Bollinger's Bollinger Bands. And I'm still a believer that Bollinger Bands have a very useful place in your portfolio, especially within trading ranges. What I found was in the stronger trends, though, they kind of race to catch up. So I needed something that's going to find that speed of movement, and that's where my acceleration bands indicator was developed, still trying to encompass about 95% of the price action. And the idea being that, guess what, if we're in that 95% of the price action mode, I want to actually trade something that's moving into the other 5% outside of those bands. And so what we've set up within the Big Trends Toolkit in MetaStock is when you get one and then two closes in a row outside of these bands, you'll see that that sets in place a buy signal. Meanwhile, this is Apple from a little while back. You can see that basically when it comes back, not just under the bands, but actually under a nice trailing stop that we use, we'll hop back out. Now you can see it's especially powerful, you know, when you get these nice little windows of time here. And I don't expect you to ultimately have to ride it back towards the you know, eventual exit on the whole position, but saying, hey, if we can get even part of this kind of an acceleration, this is that more parabolic opportunity. Now you can see sometimes it's wrong. You can see this one was wrong. It tried to get going and then it faded back down. So, you know, sometimes it's not going to get there the way you want. And other times you can see it's not going to take a signal because we've got to get more than one close outside of those bands. We've got to get two closes in a row outside of the bands. Otherwise, it's just noise. So it saves you a lot of the whipsaws that you see when you're trading and you think you're getting a breakout or a breakdown that turns in, instead of a breakout, it ends up being more of what I call a fake out. How many times have been faked out and been frustrated by the trend? You can see that in these cases, we don't try to trade that trend. We try to say, hey, that's not broken outside of those bands yet. I don't like to trade in between the bands because I'm very much prone to option trading. And for option trading especially, we want speed of movement. But even for if you're a stock trader, a Forex trader, any other kind of a trader, you want to get relatively fast moves. It's just about what's your right time frame. Now, if we zoom that in, go look at the little bit more recent action here. You can see looking at, we got one close in a row outside there, and then the second close in a row is where we get our confirmed signal outside of these acceleration bands. And you can see what happens as the stock makes a move from about the 355 zone, gets up to about 400. Okay, so that's about a 10% move. Now, as an option trader, if you can get a 10% move in a stock, especially over this relatively short period of time, you should be able to have the opportunity to potentially double an option, especially the type of options I like to buy, which are typically slightly in the money, looking for more of an intrinsic component to the option that we purchase. So if the stock's trading 355, I might buy a 350 call. Here it was in July, I might buy it out to August. Or these days you can even, for shorter term trades, trade the weekly options. But you can see, if you get another buy signal, you get one and then two closes in a row outside of there here. You can see I was coming in about 415, and you can see about a week later you're going to get stopped out about 400. So if you're buying on a daily chart, typically I'd buy out into the second month option. So if you're buying right there in mid-September, you're buying in October in the money call, and then you're blowing that one out 5 days later. So you don't lose that much time. You lose a little bit of price trend. But you can see, you know, even if you lost 15 points on the second trade versus made potentially 35 points on the first trade, you can set it up where you can make twice as much as you lose or more, especially with the ability of options to really have that running trade where it just goes and goes. More recently with Apple, I didn't pull that latest chart, but when Apple broke out here at the end of 2011 above this $400 target, we got a buy signal actually at $399 December the 23rd, and the stock actually ran to $630. You know all about Apple by now, and gave the exit back at $579. So that was about a 45% gain in the stock over about 3.5 months to almost 4 months, really about 3.5 months of trading. So that was a beautiful example of a steady trend. Now, when we go and we look at another tool that I really like, it's the Williams percent R indicator. That stands for percent range. What is percent range? It means, hey, if you look at the last certain number of bars and you say, hey, the stock's traded in a range between 20 and 30 bucks, well, that's a 10-point range. Well, if it's trading at 25, on a 20 to 30 range, you know where you are. You're smack dab in the middle of that range. You're at the 50 percentile. If you go forward and you say, hey, you know, we're looking for something where we're looking for that overbought level in the top 20% of readings, most people, when I say the word overbought, imply what? What do you think when I say overbought? You think, ooh, it's gone too far. I don't want to buy it now, but I'm going to show you something that's quite different from what the conventional wisdom is. And what I definitely recommend is that you use a different setting than the usual 10 or 14 bar percent R reading. I like to stretch mine out to a 30 bar setting. This smooths it out. You can actually look at this and see what you're missing. One of the advantages, the reason I'm willing to give you some of these tastes of what you're missing is we've coded it all for you thanks to the good folks at MetaStock. Work with them to really code you a whole lot of things. We're not just talking about one indicator. We're talking about a series of things you can use to be more effective in the market. So you can look at this and see what you're missing, but then MetaStock helps you run the scans to find, I like running these scans to find the next big mover overbought in the top 20% of readings, and then something unusual happens. It actually sees a follow through. It closes above that first overbought bar's high. So when that happens, that's telling us that we actually do have something unusual going on with a super strong trend on the upside. For a bearish trend, and I've got a variety of examples, including all the way back to the financial crisis of the financials collapsing in 2008, it's saying, hey, when those stocks are breaking down, JP Morgan, for example, recently broke down right before it announced its big trading loss, and percent R had already given its sell signal because it had closed below a low, and then it followed through a couple days later, and it had the bad news and it gapped down. Well, do you think any institutions might know about that news before the company officially announces it to the rest of the crowd? I would suggest that that's probably the case, but the beauty is that we get an opportunity here with these indicators to pick up on that strong buying or strong selling. So what you see happening here is that we look for these moves into the outside of the top 20% of readings, up above the 80th percentile, or down below the 20th percentile, and then it actually has to follow through. So you can see where we get our buy signals on gold. This is the GLD this past year, and you can see that we had the breakout, the big steady run, especially the run outside the acceleration bands, and then of course what happens? If it comes back under the 80 threshold, that's what I call a retest. If that low gets taken out, then I'm done. If it doesn't, I actually continue to hold the position. This low gets taken out here, and we're out of that trade at that close. And now you're just waiting for the next signal. So you're really trying to take advantage of the sweet spot. You can see this next signal wasn't such a good one, partly because the acceleration bands never got going. Look at the trade after that in early July last year. We broke out on gold, and we broke out on the acceleration bands. So now you get a dual buy signal there in early July, and look at how powerful that parabolic effect is as we stay overbought through the month of July and most of August until the CME starts tightening their margin requirements here. We get a retest and then a violent snap down into that margin requirement tightening. And so that was flushing some speculators out of the market. I certainly advocate, one of my option rules of thumb is if you own an option, you can do the same rule with the stock. If you can double any vehicle that you own, options are easier to double than stocks, then you get a situation in which I say take half of your money off the table. Go ahead and book half of your profits. Why? Because it gives you the opportunity to say, I can really leverage that well, and then say, hey, I'm now trading with the market's money on the rest of my position. I've gotten the risk capital back out of the trade. Even on an option, if something happens and it gaps against you and you lost on the second half of the trade, you wouldn't do worse than a break even if the second half gapped to nothing. We're going to show you how you can scale out of these trades along the way. You can see it tries to give a couple more overbought signals here right into this peak, but it can't close above that high. It tries and fails, and it keeps you out of trouble. Then you can see this next signal, it's actually breaking down as it goes into the oversold territory here. You can see where that's happening. Going oversold, breaking down with kind of a violent gap down, and you can see that signal we started to break down, but every time we test back into this, like this dotted line here, that's what I call a retest. So that's a resistance area too, where I'll also consider adding and building a position. It looked like it was working here, and then you can see what happens. It actually violates that resistance here. You got to hop out for a small loss. The nature of the percent R system is targeting bigger winners and taking smaller losers. That when you see those test points, you know you can tighten your stop, and then you can wait and see what happens from there. But you know you're going to give yourself the chance to really ride. Now, like I said before, only take half of your position on an option trade when you can get a doubler. If you do that, you'll find that this releases the fear that we all have of giving back our profits. You get your original risk capital back out of the trade, guarantee at least a break even on the rest of the trade. And then, hey, of course, we're going to keep tightening our stops. The way we do it, just give you a little more detail, is we'll ride the other half until it does one of two things. If it gives back half of its peak gain, so say it went to 150%, then it goes back to plus 75%. Time to go. Don't let a trade give back half of its gain. And then, especially, once you cross over about that 30% gain level, now you've got some room to start playing with the market's money. You can start trailing your stop. Or you can exit half again. If you've sold half of your position, you can sell half of your remaining half for a quarter of your initial position if you get enough contracts, if it doubles again. So it goes from, say you bought options at 2, they went to 4. You sell half of your contracts at 4, you get your risk capital out. That 4, say, goes to 8, you sell half of your remaining contracts at 8. So you keep on working your way out of the trade on those rare, strong trends that really tend to drive your portfolio. Now, a good example on the downside is actually Bear Stearns, BSC, back in 08. You can see here how, given one sell signal back in 07, it was breaking down from about 90 down to about 75. That was a nice little steady %R trend. Got a retest back above that 20th percentile, and then it took out that resistance right here. Just a little too strong. You can see %R starting to break again. Notice we're not getting the acceleration bands move there that we would like to confirm it, and it snapped up for a quick small loss. But then here's the next breakdown of both %R and then right after it, the acceleration bands. Breaking down, actually seeing a retest right back into that 20 percentile level on the little bounce here, and then the stock started to just fall out of bed. And this is why I say never catch a falling knife. A buddy of mine tried to call me and said, you should buy some Bear Stearns here at 30 bucks on a Friday afternoon. I said, I don't think so. I've got a real bearish signal on it where we've made money on puts on it. And the bottom line is that he's saying, no, it's a got to bounce. And then, of course, what happens? The JP Morgan announces over the weekend there in mid-March that they were going to buy it for $2 a share after it just closed at $30 a share. And everybody's like, what? So it opens at 3.5, and my buddy blows out of his for a big loss. And I said, don't blow out of it because they offered 2. They're coming in at 3.5. The market's telling you it's probably expecting a higher offer. They later had to offer closer to $10. So some people are just wrong way traders, and the bottom line is, certainly it can be helpful to pay attention to what they're telling you too. But always follow the trend. The trend here stayed bearish, and you just caught the move from 70 ultimately down to 10. Even though it bounced up, it was still a big winner for bears. So this is the kind of stuff we look for in the big trends approach. Now I want to spend a little time here today focusing on what I would call a little bit of option pricing knowledge here for you. If you're trading options, say you've got one stock that's trading in say it's a tech stock trading kind of a volatile pattern, and we're going to say both, we're going to look at a couple of examples here. Both of them start at 50, and both of them finish at this endpoint here at 60, okay? So we're starting here from 50 to 60. From the beginning point is 50, the end point is 60. Now you can see the volatility profile is going to be a little different here, where we say, okay, there's a red tech stock, and then there's a white utility stock, let's say. And let's say that the red tech stock has a 40% implied volatility. Okay, what that means is the options are priced for that stock to be a 40% volatility over the course of a year. It's going to move up or down 40%. Say the white stock in comparison is a 20% volatility. Say that's more of like a utility stock. It's kind of slow and steady, doesn't have as many moves one way or the other. You say, okay, well, if that's got a 20% vol and the white and the red has a 40% vol, well, if you were to buy a at the money 50 strike call position and you get the same move in both cases, which one do you think is going to give you a better bang for your buck in the option? The correct answer, most people tend to say the volatile one, the red tech stock, but the correct answer is the white, less volatile one, because you get the same move, but back here at 50, you pay half as much for the white 50 call than you pay for the red 50 call, because white is priced at half the volatility. So to get the same directional trend, the same percentage gain after a month, let's say, from 50 to 60, you make 20%, very big move for both of them. Well, hey, Both of them making money, but you get twice the bang for your buck on the white trend. That's very efficient, very steady. Some people told me that allows them to sleep better at night. It's very predictable, and that's what we all want, is that kind of consistency. Well, I developed an indicator called the efficiency ratio. A guy named Perry Kaufman was doing a talk, and thought, well, this concept on efficiency sounds like it makes a lot of sense. Let me see if I can code that in here. What I found was when we get breakouts, like the %R breakout, where it follows through above that threshold value there, that tells us something unusual is happening here. You see it comes back in for what he called the retest point right in here. Doesn't close below that. Takes off again. We get a couple more retests, just like what %R would look for. And this was with the silver ETF. And silver here went from about 33 on up to about 48. And then when it finally gave the last retest back in here and broke down, it gave the official exit signal back here at about $40, $41, 40 and a half, I think it was. So, nice steady move up of about 25% in the stock, almost 30%, and from the highs, of course, was even more, closer to 50%. So you see here how, you can catch these big trends. Now we're waiting on efficiency. We're not taking it as it's trying to come back up, and you see in this case, we were really waiting for more follow-through than what it gave us off the dotted line here, and just kind of couldn't get going. So we're just saying, okay, that's something we'll pass on because it's just not following through strongly enough. So that kept us out of trouble on silver. If we look at some other examples, what about the S&P headed into last fall? You can see that was the last time everybody's worried about the euro crisis, and you can see what's happening here. It's breaking down under that minus threshold here, and then it's falling through right there. Now this wasn't early 120, but over the course of the next two sessions, it went from 120 to 110. I mean, 2.5 sessions, you had a really strong break to the downside. So this is an opportunity here where you can find these steady, efficient trends, get a piece of the action. Like I said, even a 10% move on the underlying should be good for a potential double on an option, and then you move on and wait for the next trade. See, when we were getting this rally in October, it didn't get too excited about this one on the efficiency ratio. We weren't quite there yet on the acceleration bands. Those later came around a little bit, but it took a little bit of time. So this is part of what we'll teach you in the Big Trends course. Now, you go back and look at some of the big moves, the really strong efficient trends. You'll see a name like First Solar. First Solar, given this setup here, and then it followed through above those highs back here in May of 07. This was one of the best performers in 07. You can see why. That, yes, it finally came down below there and violated. We had a test back below there a couple times, but it wouldn't break that. And the stock went from about the 70 level on up here to about the 130 level, and you can see it didn't quite double, but from this perspective told you, hey, it's time to go. And then we got another buy signals that broke out yet again back in this window and said, okay, it's time to hop on board here. In this case around about 110, and you can see it ran all the way up to about 280. All these tests were just that. They were just test points coming off of lows, coming off after the gap up and the pullback on the dotted line there. Another key support. All these test points, if I could draw a straight line, were basically, and that's on me, not MetaStock, that you see they're just giving us these retest points along the way, and finally that last retest point gets taken out. That low is gone. You're done with that long trade there. About $265. It's been a phenomenal move, well over double in a short period of time. This is the kind of stuff we're looking for, and of course now First Solar has been a lot more bearish, and we've made money on it on the put side. Well, what about the financial stocks back in 2008? You saw like a name like AIG, which we know, it's been kind of a thorn in the government and taxpayers' side, and the bottom line is that, you look at it and say, hey, the government stepped in to sort of unilaterally bail out AIG for fears of the contagion effect continuing. But look what happens when this %R goes oversold, and then it breaks down and confirms that. They're just under $40, call it $39 a share. We don't actually see this oversold market even try to come out of that oversold zone until a couple months later, mid-July. And when it did, that what we call a retest was taken out there, and it's time to hop out and wait for the next signal. Now we managed to also catch this collapse here in September of 2008 when the stock was trading at about 17. We managed to say, hey, this is a great opportunity to buy some puts, cash them in about 3 days. When it gapped down to $5, we said thank you very much. Now you can see we probably could squeeze a little more out of it, but we just said, hey, that's a great opportunity from 17 to 5 in a matter of a few days. You do not want to try to catch a falling knife. That's where it gets really, really dangerous. And so we'll teach you how to avoid that by following the Big Trends tools in the MetaStock Big Trends Toolkit. So you can see a name like Google, for example. Google's been very good to me. We look at it and say, hey, you know, when you're getting a breakout here on the dotted line, actually, then it's confirming above there. It's saying, hey, there's your buy. But then look what happens. It pulls right back. You're getting a nice little retest right off of these short-term lows. This is coming the week before earnings, and you see what happens. Big pop to the upside. So, you know, certainly this is something where, you know, eventually this thing rolled over a little worse, but the bottom line was I'd already had my positive surprise. I'd already booked a bunch of profits, and now just waiting for the next signal. You can see in this case it works on both downside and upside signals. You get periods of time where we're steadily downtrending, and then you can see how %R basically stays in the oversold territory. So this is the kind of thing that we look for, and of course then this last one gave you a nice buy on %R. And again, if efficiency is not on board, I'd say just only buy part of the position. You can see it's confirmed there and buying on the next bar's open right before the nice gap up off of those earnings. So this is the kind of thing that we look for all traders to benefit from. Netflix in the past fall, you can see it had been such a champ on the upside. We'd had some nice breakouts, some nice retests where you say, hey, you know, when we've got the stock going through a little retest here, this is just a normal little retracement. And so bottom line is we should definitely look for opportunities here within this trend to buy those little dips within the uptrend. And you can see that the dip finally ended here when this last low was taken out. About 4 days later, it said, we've got to go, hop out. Sometimes you start to get on to a good start, and then it'll snap right down and take you out. That's part of trading. That's just good trading, is to know how to release those disappointments and say, let's move on to, you know, a fresher opportunity. Now on the downside, you can see with Netflix, once it started to really crack, you can see on this dotted line here, it started to break, and then it was falling through below those lows here at about $200 a share, maybe at 205-ish. And you can see then it just steadily declines here, and even the efficiency does the same thing. It comes on board and confirms on the gap down. So even if you miss part of that move and you buy the puts on the gap down, you bearish the stock in some fashion, this is an example of one where you're going to want to really position yourself to benefit from both sides of the market. We can't have a bias to only trade the long side. We must trade both sides of the market. Another favorite gold name of mine for the last 4 years, basically since 2008, has been Randgold Resources. Randgold sold a bunch of their mining interests, then bought rights in other mines. So they're even more leveraged to particular moves in stocks and in the gold sector, and saying, hey, they can really benefit if gold gets going. We can see in this case that happens, I'd say about where it normally would happen, but you know, you're going to have some disappointment there that you didn't get on earlier. But you can see in this case that we get another retest, and the %R efficiency is very, very powerful. That's a good combination. Get a nice little efficiency retest, and then from there we have something that we can really focus on for low risk entries but much higher risk rewards. So, you know, this is how this works, folks. You know, you can really position yourself to really find the best of the best approaches. And I don't know if I did a screen grab of a scan, but that's really what we're looking for, are these scans to go find the next potential great trade. There are no guarantees in trading. You're going to have losing trades, but part of the key is filtering out enough noise so that you increase your odds of success. So, you know, from this perspective, you know, I really feel like, you know, you have to make sure that you're being wise about things. And relative strength, you may have heard this concept. That is not the RSI, not the relative strength indicator, but the relative strength, relative performance method. That, you know, what I'm looking for is how stocks are performing against each other. So I can actually run a scan and rank them by which ones are the most above their 200-day on down. what's cool about this particular indicator is this came about because one of my students from one of my seminars came up and I was pointing out an example back in the mid-2000s on Taser, and they said, that's interesting, I didn't trade Taser because it was too extended above its 200-day moving average. And I said back, that's interesting, I'm going to test that to see if that actually tests well or not. If you don't buy something above its 200-day moving average, or if you actively short it, you're actually putting yourself in a lot of risk based on the testing, is that these momentum stocks can go a lot further than anyone would expect. So that was a surprising result. They'll tend to, even once they cross 100% above the 200-day threshold, they'll lift off even further into that orbit potentially. So my basic rule is once the stock goes 100% or more above its 200-day moving average, then I've got to get a close and a subsequent bar above that bar's high to tell me that we've got a new confirmed buy signal. And then once it crosses back under that 100% line, that sets a new stop at that low. If it closes under that low, I'm done. I'm out. Sayonara. Always exit first, ask questions later. So Fox News called me from a prior example here, and they said, hey, we want to find something that has had a pretty good run, but you think can run even more. And I ran my 100% above the 200-day scan back there in May, and I said, look, we're crossing right now on TBSI. And they're like, all the other commentators were sort of dumbfounded and said, why would he recommend something that's up that much? And the point was that, look, we were getting these nice retest signals. There's the retest. It didn't close below that low, and you're able to ride it on up. So again, we get a situation here in which it's got that upside bias. It's, clearly a situation in which, hey, we can buy those dips, and then, hey, if we buy a dip and we're wrong, like this one, you're going to get stopped out ever so slightly by 1 bar. It's kind of nasty. It went from about 34 down to about 28. So pretty nasty little quick one-day pullback in that case. But then it re-signals you back in, and then you're seeing all these successful test points where these lows are actually holding. This one may not have. It looks like it hopped you out and then got back in later on this chart. So, from this perspective, it breaks out above that high, then it's closing above there, and so that's all clear signal, and this thing ended up going on into the 70s. So from this perspective, you can see a lot of different indicators and methodologies that you can really put to work in your own trading and investing. And like I said before, there's all kinds of time frames. So this is an important chart here, an important summary of what I find on the %R signals, for example, is they tend to be good about 20 to up to 30 bars. Now they can be good longer, so you can still let them run. But the bottom line is that it's all a function of understanding where your opportunity is. And so what I find is that if I'm talking to day traders, I would suggest that you would kind of make your core time frame the 15-minute chart. That means every 15-minute interval you get a new data point. Now a lot of day traders or 1 or 2 day quick traders would tell me, are you crazy? I'm looking at the 1 minute or the 3 minute or the 5 minute chart. Why would I look at the 15-minute? Well, again, that's something you can really determine, hey, what's the best of the best approach going forward. I find the 15-minute very stable. You can see for swing traders, 2 to 5 days, I'm really focused on these hourly charts, these 60-minute charts. So there's 6.5 hours in every trading day. So over the course of 20 or 30 bars, that puts you out to about 4 trading days on average as a holding period. For position traders, 1 to 2 months, we consider the daily chart the most telling. You can also still look at what's around it. You can see the weekly. You can see pretty much how everything is set up. The weekly chart followers are really best to focus on that 3 to 12 month horizon. And then the longer term traders, if you're 12 months plus, you can still focus on monthly charts, and you can find some pretty substantial moves on the monthly charts. So my experience with that has been, that we really do want to take advantage of these best of the best opportunities. So we talked about some of these. You can even see on this chart underneath here, like Amazon. That was an Amazon efficiency ratio where it had gone bullish and set up here right about $41, and it followed through the very next bar, and so it's buying on that next bar's open. and from 40 bucks it went on up to 70 with a couple what we call retests. Even efficiency, when it pulls back under its top threshold, the inclination is, well, I should get out, right? Well, if it violates that low, you should. But if it doesn't, then you've got a situation which, hey, we're really looking for, okay, these steady trends with a really good, solid upside bias. We don't want to put ourselves in a position where, we trade the noise. See, I think that's a mistake a lot of traders are making, is they figure they can scalp a range. But the problem with a range is typically that it'll work for a little bit and you're kind of getting used to buying low, selling high, buying low, selling high, and then all of a sudden it'll break down. You bought low and now you're going to get hammered when it snaps down hard to the downside and have to end up, you sold it low, you got to buy to cover a lot lower. So you basically, so you bought low and you're selling out a lot lower. So you're actually losing on that trade. Same thing if you sell high, if you're selling short or you're buying puts in the top of a trading range, and then it breaks out of that range, and all of a sudden you're like, now what? What do I do next? So this is very important. So, from this perspective, we really want to factor that in very, very carefully. Now, I know all of these indicators are available on the Big Trends Toolkit, and we do have this add-on special here. It's $100 off for attendees. I'm going to just go back for a second and just kind of reiterate a couple things, and then I'm going to hand it back over to Kelly and Alex. But, you want to look for these trends. And so let's just go back for a second and just look at, because I've got a little bit of extra time here, want to just remind you what you're looking at. And let's just look at another example here, for example, on Rand Gold. Okay, so this is GOLD, it's a stock. And when I pointed out Rand Gold to my Big Trends community back in 2008, stock was a lot lower, and basically I was saying, hey, I'm bullish on gold, and Rand Gold fundamentally had sold out some of their mines and had bought these royalty rights. So from this perspective, I was like, hey, they're going to be even more leveraged to the price of gold. That's a good thing if you think gold's going up. So when you see something gap like this, a lot of times on a gap, you'll see %R get up right near the top of its past 30-day range. Remember, if the stock, in this case GOLD, was closing back over, say it was closing at the absolute high of its range over the last 30 bars, what would %R read? %R would read 100%. So in this case, obviously it hasn't gotten there yet, but it's breaking out of the top 20% of readings above the 80th percentile, and then it continues to surge higher in that next bar. That's where we're getting the buy signal at that close of that next upwards bar, because it's saying, hey, this is a breakout, and this thing should get going outside of the bands. You see efficiency comes on a little bit later, but notice what happens after that. Then we come in and we get what we call the retest. Now we've set up code within the MetaStock scans, what they call the Explorer in MetaStock, where you can go in and say, okay, I want to buy a breakout or I want to buy a retest. What's a retest? A retest is when it comes back underneath this 80 percentile level, and you see where that happens right off this short-term low, and it says, hey, that's a key support. You can actually put on trades right into that retest level and find what I call low-risk entry points. Now this one got a good entry. It started to move up, but then notice what happens. It actually starts to have another retest coming right off of here, and then it actually hops you out right after that. So it's saying, okay, you're just not getting the kind of pop that you expected, and this will prevent you from adding capital into trades that you think are quote-unquote value trades and saying, no, don't do that value game. The value game gets you stuck. It gets you stuck on non-movers. Even if something doesn't go against you, say you buy the stock, and even if it just flatlines, why would you want to be stuck in a non-performer when you could rotate your capital into a better performer? So you see this next trade is a much better trade, obviously. You see where %R breaks out here. We had the surge back there in late June above that 80th percentile. Notice, by the way, you kind of stayed away from this zone inside the band. So, this zone where I call it the no man's land on %R, where it's just stuck in between that 20 and 80. Actually, it did try to give a sell and stopped you right back out late in that lower end of the range when it was trying to break down and didn't follow through. You took a quick loss 3 days later. But the bottom line is that, look, the good one should run, and this next one that ran on the breakout, you can see, look where the breakout level is. It's at about 85 bucks. Look at where it ran to. Ultimately, it ran to about 113. You can see that the stop out officially came where? It came when percent on this last retest. That retest level should have held, but it actually violated, and it's telling you got to hop out here at about 105. So again, I moved from 85 to 105 from the beginning of July to the end of August. That's a 2-month move, and you've seen an opportunity to take 20 points out of that stock and ultimately out of those options. That's where you get great leverage. So from my perspective, that's what I'm looking for. Notice what percent R also does a good job of doing is how many times you get a setup here, but it doesn't follow through. So you get the shot down right there. It snaps back up. So what do you do if percent R goes back above the 20th percentile without falling through? You turn off that setup and you wait and try again. You had a couple more attempts, including this last one where it tried to break to a new low here, but it doesn't follow through. You just basically don't even take that trade. So one of the beauties about the scans, saw the same thing by the way on the upside, where it just tried to break out and it couldn't a couple times. You see those attempts, and it's Xing you out. It's actually, in this case, Xing you out of more setups and not taking those setup trades the next bar or two and then turning it off than it is taking the valid signals. So it saves you a lot of noise, a lot of information overload. And I would ask you, what's that worth to you? How many times are you getting whipsawed by trades and losing money when you, based on the methods I teach you, would tell you, don't even take that trade in the first place. Don't even get that into your atmosphere, into your mental visualization of what you're looking to happen, because the reality is until we get the confirmation, it's a waste of time and a waste of energy to try to follow those names that are not on a confirmed signal. So from my perspective, this is extremely important information, because what it's allowing you to do, it's allowing you to not get your capital so tied up for very long in any kind of a non-moving situation. It's going to basically force you out of that trade relatively quickly. So going back, let's look at one more example. Just looking backwards for a second. I'm going to go back to a prior chart. Okay, so Netflix. We talked about Netflix on the way up and the way down. You can see, for example, back in August last year, the market was really dropping like a stone. Netflix set up right there, gave the confirmed breakdown signal right there in the neighborhood of about $240 a share. Okay? It got that initial pop down over the next couple of days to about $225. Not a bad initial pop. Maybe, but probably not. You're not going to be able, because Netflix is priced so high, you're probably not going to be able on a 15-point move to get a double on the Netflix in the money put. I'm sorry, but 15 points sounds great, but it's just not going to be quite enough. So now what are you waiting for? Now you're saying, look, now we're looking for that next retest, which you can see here comes in right about this level. Now you can see it's ever so slightly going to stop us out a couple bars later, and you're going to end up taking a little bit of a loss if you're an options trader. If you were a short stock trader, you'd break even. But as an options trader, I've had about 2 weeks go by of time, and I haven't seen much move. It's kind of flatlining effectively. It was down. It was making money for us at first, didn't quite get to the double. Now it's basically come back around break even. My rule of thumb is if it's wrong after 5 trading days or more, get out of the trade, period. This will avoid that issue that we all tend to get into of, yeah, well, the market's not validating it now, but if I just am patient and wait, it'll eventually come back and validate me. That's called trading your beliefs and not trading what the market is telling you. The beauty of the MetaStock platform as a whole and our Big Trends Toolkit plugin and add-on for this is that we're systematically taking our emotions out of the market. If you go back and look at the worst trades I ever did, the worst trades I ever did were trades that I could have taken an exit and kept my loss small, but for whatever reason, I let my emotion override it and I rode it out to a bigger loss or even possibly a total loss on an options trade. Now, part of what allows us to stay in the game is that we never recommend being all in. We recommend that you focus on, consistent money allocation. So no one trade is going to make or break you. It's about following a process of trades. But the principle here is that you can see that by the time that Netflix really gets rolling on the downside, we really poured on there over those last month of mid-September to mid-October. Netflix eventually bounced back, but bottom line was, you can see this does a really good job of not only telling you when to trade in the direction of the trend, but what I love about it is, look at percent R, for example, back here. It gets one pop above that overbought level, but it does not get the follow through. Yes, it even got a follow through, it looks like here, and then had to stop you out back there in late April, early May. It stopped you out on that left side of the chart. But other than that false signal, it did a really great job of not allowing you to get on board even in the midst of what looked like some bounce attempts. You can see it tested to the upper acceleration band even there in early September of 2008, but notice percent R and efficiency were nowhere near their buy zone levels, and then eventually got another sell back there at 17 on the way down to about 3 and change. So certainly something where you can see the power of that, how it looks, and how we can all benefit from those super strong trends. That's what I'm got my system running right now, is looking for the next big trend to the upside or to the downside. So that's important. You've got to be able to trade both ways. So maybe let's just go back and look at one more example here, and then I'll hand it back over to Kelly and Alex. So we talked about First Solar. Let's go look at another one here. Let's just go back here for a second to the S&P. So last June actually had a profile that I think looks kind of similar to the current market. We had a weak jobs report. We broke down on that jobs data right there at the start of June. Okay, so if you're looking at this and you're saying, okay, well, it's coming in about this level. We're already starting to come down. Then we came in and confirmed that sell signal. Now, if you feel like you've missed a move, if you feel like a move is too extended, you can always wait. And what do you wait for? You wait for the retest. The retest is where you've broken down, you've got a confirmed sell, and then it comes back, and it actually gives you, on this little snap up here, it gives you what we would call a retest. So that's another spot to say we could tighten our stop if we're already in a trade. It better not close above that high, but we can also trade it, and in this case it snapped right down the next day. Had another one of those retests that happened right here, and you can see same concept. You get a good low risk entry, and it causes you the somewhat of the concern that, hey, other people don't know about this, that they can't take advantage of it, and the reality is that's a good thing for you. You can see it trades down. Now it tests back underneath that, but it can't follow through below that low. That's kind of an early warning signal that all is not right here in Denmark, the bottom line, or in the S&P 500, that we really have a market that's trying to find a base and trying to snap back. Then, of course, you get the acceleration move outside of the bands. So, in any case, this is part and parcel of what you have to make sure that you get covered, that you're finding these opportunities in the current markets. All right. So, that's, like we said, when we really look at, the nature of what you're missing, like we said, and you got your time frame for your signals, all types of traders can benefit from this. You just have to find the right sweet spot of your trades. Long-term folks can look at weekly and monthlies. Shorter-term position traders, about a month or so, can look at a daily chart going out about 30 days, or going down into the 15-minute chart for the day traders, the 60-minute chart for the swing traders. There's something in there for everybody. And like I said, in the toolkit, the Big Trends Toolkit for MetaStock, there's something in here for everybody, and there's a lot in here for each of you. That, certainly I'll focus on percent R, but I'll add in these other tools that will back it up, like the efficiency ratio, like the acceleration bands, and then, of course, like even if I need to filter a really big up market, the percent above the 200-day or even the 400-day can be very useful filters for stocks that are moving, because they should move dramatically up above their threshold values. So, again, this is part of what we're looking for, is what kind of feedback you want to give us about what's worked the best for you. I love getting those unsolicited testimonials, and people just drop me an email and say, hey, I made money with this. Thanks. That's what it's all about, is defining your risk, defining your reward, and then knowing how to book a profit and then trail your stop on the rest of the position. So like I said, I'm going to go ahead and bring Kelly and Alex back on, and they can talk about how we're doing 100 off for attendees here, and they can walk you through their much more comprehensive slide here at this time to kind of show you how you can get started with the Big Trends Toolkit within MetaStock. So hand it back off to them, and thanks for being with us, and I'll stick around if they want to answer any text questions after they're done. Thanks.
Great, thank you very much for that webinar, Price. Great information. Just a little bit more about what you get with Price Headley's Big Trends Toolkit. That comes with 17 indicators, 16 system tests, 16 expert advisors, and 16 market scans. And basically you just drop it in your MetaStock and install it, and it'll be ready to go. And as part of the 80mm52 offer, which I'm sure you all are aware of, you can save $100 off the price, which is the best price you can get it for. Normally it sells for $4.99, but right now we're selling it for $3.99. So if you want to take advantage of that offer, call our sales department at 800-473-5150. Thanks for your afternoon.